So we'll welcome everyone to Utah First Time Homebuyer class. Don't make these costly mistakes. My name is Rob Aubrey, and I'm with Aubrey Home Loans. And we have Christine on with us. She's off camera and muted. So Christine works with us.
Hi, Andrea. Good evening.
Hello.
So we always, as a first time homebuyer, do you feel, concerned, stressed out, intimidated, anxious, uncertain? These are the things, these are the feelings that go through a first time home buyer. So would you agree with that, Andrea?
Um, well, I would like to can you hear me?
Oh, yeah.
Okay. I'm looking into buying a home, but I'm not sure where I want to live. So
Okay.
now I just want to get more information.
Sure. Well, most of this we'll go through as financing. And then if you need an agent, we can refer you to an agent. Okay. So
Okay.
next slide. So my name is Rob Aubrey. I've been in the industry for 32 years. I'm a licensed mortgage loan officer. I've been a real estate agent, a real estate broker. I've owned a company. I've been through every market cycle, and personally have bought and sold many houses and services service all of Utah. So that's a little bit about me. And here's some what do you call these reviews from agents that I've helped. This is what Gary says. Rob was able to get a loan for one of my clients that was far from an easy slam dunk loan. I appreciated Rob keeping me informed throughout the entire process. And then Becky, she said, Rob got a great rate and found the best loan for a first time home buyer that she was working with. He kept everything moving and made it an easy process. This was great to work with Rob. So those are a couple of real estate agents that I've helped their clients with. And so what are the steps to home ownership? One is, come to this class and learn everything, right? And then two, we get a pre-approval with a mortgage broker. That's me. And then we got a link there that you can book an appointment. And then first time home buyer qualification, guaranteed approval. So that will get you a loan. Then you house hunt with your real estate agent, search and find, offer and negotiate. You do a home inspection and review if it's a condo, finalize financing, get all the waivers done and sign not with the lawyer, but at title, and then you move in. So it's easy. Sounds easy enough, right? So mistake, not getting pre-approval, not getting a pre-approval. So that's a big mistake with buyers. So let me go through why that is. So when you're out there, I said, imagine finding the perfect house. You want it, you make an offer, only to find out you're not qualified to buy that home. That would be heartbreaking. So we have Connie coming in. Welcome aboard, Miss Connie. So that's why it's a big mistake of not getting pre-approved is, imagine finding a perfect house and then you can't have it. It's just heartbreaking. So then the seller, when you're making an offer on a home, the seller wants to know that you have a pre-approval. They want to make sure that you're ready to go. You're a sound buyer. And so pre-approval, you can actually negotiate a better price, because, if the seller says, hey, is your buyer approved, or the seller's agent, and they're like, well, they talked to a lender once and you're not so, they're not so sure. Well, but if you got a pre-approval and you're ready to go, and as the mortgage loan officer, what I do is when you're making an offer, I communicate with your agent and they let me know when you're making the offer. And then I actually call the listing agent and I let them know, hey, this is, this borrower is approved. We've done this, we've done that. Have we looked at their paperwork? I've looked at their credit and all that kind of stuff. So anyway, so are you out picnicking, Connie? So it's like, okay. So anyway, and so not to mention a heartache if you're not approved, right? So pre-approval can save you time and it can save you money, because if if you're approved, you're negotiating from strength now. And so it makes you a good, well-qualified buyer, and that helps you to negotiate better. So myth, thinking you must get a first-time home buyer loan. That's a myth. So there are programs that are first-time home buyers, but you've heard of the old expression, it comes with more restrictions than a cheap airfare. And so it just depends. I mean, there are sometimes the first-time homebuyer program is the right program, but what we do is we look at each individual case, and then what I do is, so the way I do it is, we do a loan application, we talk on the phone, we do a loan application, and then I do what I call a mortgage consult, and where I meet with you one-on-one on a Zoom call, and I'll go through a couple different scenarios and say, if we do this type of loan, this is what it looks like. This type of loan looks like that. And, and then you make your decision what you're thinking. Does that make sense? So if you have any questions, you can either just unmute yourself or just type them in the chat if you want, but it's just a small crowd. So we can just unmute yourself, and I don't mind people being unmuted in a small crowd. When you have a large crowd, you got to keep everybody muted. You get too much noise. And so, yeah, so people think that you got to get the first-time homebuyer loan, and that's not always true. It's, excuse me, let me take a sip of water. Not to say we would discount out a first-time homebuyer loan, but don't get hung up on the phrase, we're always going to look for the best loan possible. Does that make sense? So what determines which loan is that best for me? I should have spell checked that one, huh? So which loan is best for me? So, and again, so the things that go into a loan is your credit, and then what they call debt to income, which is AKA DTI. So what that is we take your total debt and then we divide that by your income, and that gives us a ratio. How much down payment you have, rate. So everybody focuses on rate, which is very, very important. However, there's two things to know about a rate. You have the rate and then the cost of the rate. So like I can get you whatever rate you want, it may cost you an arm and a leg to get to that rate. So the way it works is the lower the rate, the higher the cost. Okay. And then there's a sweet spot with the rate's a little higher, but the cost is lower or zero. So it just depends, we go through that, and everybody's different. We don't want to discuss each other's personal finances in a group setting. So there's put a link in the chat. And if you want to schedule an appointment anytime, you can just click on that link and book an appointment with me, and we'll go through a consult with you and figure out what works best for you. Okay, so credit factors. So, scores, there are different scoring models. So typically when people pull their own credit online, they're pulling, like the free versions, whatever. Now you have to understand that there's different scoring models, meaning if you go to get a charge card for $300 at a department store versus you're going to borrow $40,000 to buy a car, or versus you're going to borrow $500,000 to buy a house, each one of those is going to look different. The creditors are they're looking for different things. So they run different scoring models. So literally you can run all three of those types and get three different scores because they're looking for different things. They look at you differently. So there's minimum scores. So typically, like most programs are looking around the 620 score. Now we have programs that'll go to 580. Now we have some that even go lower. However, you have to have a larger down payment if you go lower. So you want to manage your revolving debt. That helps you with your score. So tip on the next slide. So let's see the tip. Nope, actually where's my slide? So this is my first time doing this webinar. I apologize. I had the tip, but it's I don't know where the slide is. I super apologize. All right, so please forgive me. I know the information. I'm just the first time doing the presentation, so I'm a little off on the slides. So the next slide is, what you can and can't use for down payment. So you can use retirement money, you can use gifts, you can use stocks or bonds. What you can't use is credit cards. You can't use a loan. Now, there are some loan programs that you can borrow the down payment in conjunction with the purchase, but you can't just go out and get a loan. Well, you can, but here's the way that works. So let's say you're doing an FHA loan that requires 3.5% down. Well, the lender expects that 3.5% to be your money. So you qualify to borrow 96.5%. So if you borrowed at 3.5%, well, you're not borrowing 96.5% anymore. You're borrowing 100%. And that's a different, and we do have 100% loan programs, but they have different requirements. You can't use undocumented cash. So if you have 20 grand in cash you want to use, it's what we call mattress money. Well, you got to get it in the bank and it's got to be deposited for 2 months. So it's got to show up on 2 bank statements. So buyer's eligibility based on underwriter review, your ability to repay the loan, your willingness to repay the loan, and the collateral. And so the ability means your income. Do you make enough money to pay this loan? Your willingness, that shows up on your credit report. And the collateral, that's the property that you're borrowing the money against. So does that make sense, everyone? So far?
Yes.
Good. So next slide. So this is a no-no. So no furniture, no new car. Do not do anything to change your credit profile after application. So what a mistake people make is they get excited. They're closing next week. They go to RC Willey's and they buy all kinds of furniture. Boom, shows up on their credit report. The lender, sometimes they run the credit at the last minute just to make sure there's no new credit. Lo and behold, there's $20,000 worth of furniture. Boom. Now you have too much debt and you don't qualify for the loan. So do not do anything with credit unless you talk to me first. So what do they say? The 10 things you need to know about a loan, right? Number 1 is call me, Rob Aubrey, and I'll handle the other 9 things. So that's the 10 things you need to know about a mortgage. Number 1, call me, I'll handle the rest. So let's look at down payment. So VA, so if you're a veteran in the military, or USDA, if you're familiar with USDA, they're what they call rural housing. So if you're living out in the rural communities, you can get what's called a USDA home loan, and they have a 0 down program. Now it has a 1% upfront funding fee, and then VA is an earned benefit for people that served in the military. And we won't go deep in the weeds on the requirements there, but if you are a veteran or your spouse is a veteran, then we can get the VA home, and they require 0 down, and they have no mortgage insurance. And we'll talk a little bit about mortgage insurance. You guys, are you familiar with mortgage insurance? And I'll get into that for a minute, but let me blow through these. So FHA is a 3.5% down. And then conventional, we have a 3% first-time home buyer conventional. So, but typically it's 5 to 20% down. And then we have grants and DPA. DPA stands for down payment assistance. So mortgage insurance is, so typically a lender will not loan you money if you have less than 20% down. And so, well, that means most people couldn't buy a home. And so income, because that's the magic number for lenders when they're loaning money, because for the lender, it's all about risk. And so what they do is they calculate the risk. So they've determined that if you put down less than 20%, their risk is higher, because in the event of a default, they have to foreclose and take the property back from you. And then they figure by the time all the missed payments and the legal fees, and then they take the house back, then they got to prepare the home to get it on the market, and then pay to sell it and all that. They figure that comes out to 20%. So that's how they come up with the line in the sand for 20%. So then in comes mortgage insurance. So what that is, that's an insurance policy that insures the lender in the event of a default. So if you default, then lender takes the property back, they file an insurance claim, and the lender gets made whole. Does that make sense? Okay. So this is what debt to income ratio looks like. Take your total monthly obligations. Yeah. So your car payment. Now, this doesn't count utilities or anything like that. It just counts like loans, car loans, student loan, credit cards, anything like that. So they take those total monthly obligations, and then we divide into your monthly income, and that comes out. So let's say you make $4,000 a month, and you have $1,000 worth of debt. So you have a 25% DTI, debt to income ratio. So then there's two ratios they look at, what they call front end or housing ratio, and then back end which is your housing and all other debts. So different loan programs, they have different ratios they go by. So your housing ratio is how much is the monthly house payment, and that's what they call PITIA, PITIA. So PI is principal and interest, TI is taxes and insurance, and A is any association dues that may or may not be there. So they call it PITIA, PITIA. So that's your housing expense, and then they add that. Then they add all other debts to it, and that becomes, so you have your housing ratio, and then your back end ratio, or your DTI, your total ratio. So we talked about mortgage insurance a little bit. So rates rates are dependent upon your product type, whether it's FHA, VA, conventional. You have dependent on your credit score, dependent on your debt to income ratio, the loan to value, the size of loan, whether it's a condo or a house. There's all kinds of variables that have an impact on what the actual rate is. So condominiums actually have a slight pricing adjustment. Utah has a pricing adjustment, so most states do. So, and then PMI stands for private mortgage insurance, is what you get on a conventional loan. And then MIP is a mortgage insurance premium. That's the type of premium you pay on what's called an FHA loan. And so it's usually required on most loans with less than 20% down. So then we always have to ask the question, how long do you plan to be in the house? So those are always great questions. And, when we get together one-on-one, we can talk about those and build a plan. So now by law, I'm what they call a licensed mortgage loan officer. However, for all intent and purposes, I'm a debt manager. So I'm going to help you manage debt, to use it to your advantage, to leverage, to get into real estate, because the key right now, the key to building wealth is to get property that keeps going up in value. Because if you're renting, well, you're paying a house payment anyway. So, but if you buy, you're paying a house payment, your house value keeps going up, and every payment, your balance of your loan keeps going down. So you get that, your balance goes down and your value goes up. So you're building equity. If you live in a house for 30 years and pay it off, every dime, every mortgage payment you make will literally, if you sold, so let's say you lived the house 30 years, you paid the payment every month for 30 years, every dime you ever put in that house, if you sold it, you get every dime back, and you basically got to live there for free. One of the questions we ask is this a forever house, or is this a stepping stone house? I tell people, depending on your budget and whatnot, get in the market. And then as you build up equity, then we'll get you another home. We'll step up, get you a bigger home. Sometimes you can rent out the first one and buy another one. Now you have two houses going up in value. Make sense? It's all about you got to get in the game. And it's a game. You got to get in. So types of loans, we talked about these briefly. So FHA, right? So typically FHA has lower rates, and then they lower down payment 3.5%, and they allow for a higher debt to income ratio. And then they have a fixed rate MIP, which is a mortgage insurance premium. So it's 0.58%. And so what they do is they take your total loan amount, times it by that, divide it by 12. That's your monthly mortgage insurance premium. And then you pay an upfront funding fee of 1.75%. So let's say if you borrowed $100,000 at FHA, they're going to tack on another $1,750 on your loan. So you would borrow $101,750. So that's their funding fee. That's how FHA, self-perpetuates itself. And then you have VA. They have a discounted rate. Again, that's a benefit for a military veteran or certain spouses. of military veterans, they have no mortgage insurance, but they do have a funding fee of 2.3% unless you have a 10% disability. And anybody that served in combat has what they call tinnitus, and they just got to make sure they file the claim because, I mean, if you listen to cannons and bombs going off for a couple months, you become hard of hearing. And so they can all get that 10% claim. So the next loan we have is conventional, and that has private mortgage insurance until 20% equity is reached, right? So like if you're paying on a house, let's say you put 10% down and the house goes up 5% in value, and then over the time you paid it down 5%, you can order an appraisal and then remove the funding or remove the mortgage insurance. And they don't have a funding fee either. So USDA rural housing, discounted rate, but it's rural location. It's not, you're not going to get anything in the city. There's no rural housing in Salt Lake County. You know, the outskirts of, you know, once you get past like Provo and that kind of stuff Utah County, you know, you got to be in the real rural communities to qualify that. And there's an address on that. I had a link out. Let's see if I can find that link. I'll drop it in the chat. You can use that link to go ahead and search for a rural housing address. Let me find. I'll just research. USDA address. Look up. Let's see. This is it. No, that's not the one. I used that one. Let's see. Yeah, this is it. So this is the link for if you take that link and then you can look up an address to see if it's qualified for a Utah housing type loan. So it's a good program. Now they have income restrictions and whatnot, but if you qualify, it's a really good program. So fees. So, you know, loans are not free, meaning, you know, there's cost to get a loan. You know, the lender charges fees. There's a cost for the appraisals, usually around $650. Title insurance can be about, I don't know, $1,600 to maybe $2,200, depending on the price of the home. And so the way that works with title insurance is, so when you buy the property, you know, when you get a loan, the lender wants to be insured that they're the first lien holder. Because the way the liens work is there's an expression that says first in line or first in time is first in line. And what that means is in the event of a foreclosure, the first in time, it gets paid first. So if they sell the house and there's a first mortgage lien, that gets paid first. If there's a second lien, any money left over pays the second one, and then and so forth. And so that's why it's called first in time is first in line. They want to be insured that the property's yours and that they're first in line. And then you have prepaid taxes and insurance. So those are things like, so sometimes, typically you have to give the lender, like they set up what's called an escrow account. That's back to the PIDIA, right? Principal, interest, tax, and insurance. So every year, so you're going to pay, at closing, you typically give the lender 2 months of insurance. You buy a whole policy of insurance for 1 year, but then you give them 2 months for the escrow account, and then you give them 2 months for your tax account. And so then every month you make 1/12 of your tax payment and 1/12 of your insurance payment into a lender escrow account. And then come November 1st, they pay the annual taxes on the property. And then whenever the insurance expires, they'll renew the policy. But they want to make sure those taxes are paid and that the property is insured, because remember, the property, that's their collateral, you know, because if the house burnt down and you didn't have insurance, I mean, well, guess what? You're going to stop paying, and the lender is not going to be too excited about that. Any questions on this part of it? No?
No.
Okay. So let's go to the next one, myth. I have to use my bank because I have an account there. So people think if I go to my depository bank, they're going to get a better loan. Well, that's a total myth, And so most banks and credit unions, they're loaning you money. So to give you an insight on how the mortgage money market works. So, like the lender finances the loan, and then they usually turn right around and sell the loan into what's called the secondary market. And so the primary market is where the consumer borrows money. The secondary market is where lenders sell the loans. And then, because if you think about it, if a bank had $100 million to loan out and they lent out all the money, now they'd have to wait to get all that money, collect payments every month to get the money back. Well, they don't want to do that. Banks typically aren't in the business of collecting payments. That's what they call loan servicers. And so a lender will typically, and even including depository banks, will loan you the money and then turn around and sell the loan. So they make a little bit of money on it. So that's no different. They're doing it, and they typically have their niche products that they like to do. They tend to be more conservative too. So I'm a mortgage broker. So we work with over 240 lenders. So I can find you, so whether, the odds of you coming up with a circumstance we can't figure out are pretty slim. So any thoughts on that? Does that make sense? And so
Yes.
the other thing is too, and I don't want to, I hate to bash people. Like if you get somebody working at a credit union, like last month they were a teller, now they're a loan officer. I mean, they really don't know that much about loans. And so where someone like me, this is who I am. I live and breathe this. This is my business. I'm at 7:00 at night and, I'm on a webinar with you. Those people that work at depository banks, you can't get a hold of them on the weekend or after 5:00. If you got a question at 7:00 at night, text me. And if I'm available, I'll call you right back and answer your questions. So that's another major difference between someone like me and a depository bank. A myth, you can only pay your monthly payment is. So that's a myth. So let's see, my slide is out of order. Oh no, it didn't. There we go. So you can only pay. So let me show you the next slide. So what I did is I took a $500,000 loan, and I forget what interest rate I threw in there, but the principal and interest payment would be $2,998 a month, right? For 360 months, that's 30 years. So the total interest you would pay in that 30-year period would be $579,000, and that's not 79,000 above. That's $579,000 in interest over 30 years. So now let me show you a little trick. So just a disclosure, I'm not a CPA, an attorney, all that. But if you were to make an extra $50 a month payment, you knock off 15 months. And that now you only paid $549,000 in interest. So you literally saved $30,000 just by throwing $50 a month extra every month. And if you throw $100 a month extra, now you're down to $522 and you're 331 months. So literally you knocked off 29 months. That's what, 2.5 years. And then if you did 200, you're down to 306. You knock 54 months off the loan, and your interest is now 476. So literally between the two, if you did $200 a month based on this loan scenario, you would literally save $100,000 and knock 54 months off, which is what's at 4.5 years. More than that, I'm sorry. So yeah, 54, that's almost 60. It's almost 5 years. Yeah, 4.5 years. So does that make sense? So you save a lot of money, So, I mean, that's how you do it. And like I said, I'm a debt manager. I will help you manage your debts, So we look at different things and, before people say, well, I want to wait and I want to pay this off. I'm like, before you do anything like that, let me look at it. And then I'll make sure you get the biggest bang for the buck. Because sometimes people think, well, if I do this, I do that. Like, don't close down any credit card accounts or anything like that. That could actually hurt you. So Next thing is buying directly from a builder. That one, people are like, I'll go right to the builder, right? Well, let me give you an insight on that. So the cost of buying straight from a builder, anywhere from 5 to 40,000. So you got to remember the builder is building and selling for their benefit. They usually have an agent that represents the builder. And then, and they always want, so you go in, you fall in love with the model. You're like, oh, I want this house, why not? It's gorgeous, right? It's got every bell and whistle. It's decorated to the nines. And you're like, yeah, I want that. And they're like, you want the crown mold? And you're like, oh yeah, I want the crown mold. The crown molding costs you an extra, I don't know, $8,000, And so, but the thing is, and your agent can help you with this. You talk to your agent and the agent's telling you like, look, don't spend an extra 8 or 10,000 on crown molding unless you got the money, because it's not going to increase the value of your house. So you could do 30, you can do 20, 30, $40,000 in upgrades, but you're really not improving the house value that much. It's just what the builder's charging for it, and so, and they use their own comparable sales, so they make sure it appraises. But, so you want to kind of stay away from that, because a good agent, when you work with a good agent, they'll give you insight to say, if you do that, the value is only going to go up this much. And, if you go to sell the house in a few years, the buyer's saying, well, I'm not going to pay you $10,000 for your crown mold, and I don't care, So does that make sense? So you got to watch, an agent will help you. An agent can look at all the builders' houses. An agent can look at and say, no, that's not worth buying. Okay. Agent can tell you whether it's a bad investment or not. Thoughts, questions, concerns, hallucinations? Anything? No? You guys are still with me, right?
Yes.
So hey, look, I have fun. If you're not going to have fun, right? Go home. So life's too short not to have fun. Now, this is serious business. That doesn't mean we can't have a little fun along the way, right? Big mistake is skipping a home inspection. Oh boy. That could be huge. You can have a furnace that's got a crack in I forget what they call that. There's the drum in the back. Now it's leaking carbon monoxide in the house and poisoning everybody. Now it's costing you 8, 10, 12 grand to replace it. Where a basic home inspection, would have unearthed that. A home inspector can look at the foundation and say, hey, I'm seeing some issues. We may want to have an engineer look at this, depending on the type of house, the age, and all that kind of stuff. But typically a home inspector will, and it's a visual inspection. Obviously, they can't take the house apart. And the cost range anywhere from $275 to $650, depending on the size of the home. Like if you have a small condo, it's going to be $275, because if you're in a 3-story building, they're not inspecting the roof and that kind of stuff, because that belongs to the HOA. But they inspect the systems, like the standard HVAC. HVAC stands for heating, venting, and air conditioning, right? They check the electric, they check your plumbing, the roof, the appliances. And then there's additional inspection. So that comes with your standard inspection. And again, it's a visual inspection. Like they'll take the cover off the panel box, make sure the electric looks safe. They take pictures of it. And if there's any questions, we work with electricians. We just send them pictures and get their opinion. Sometimes they're like, well, it's a $40 repair. Okay, $40 repair. Congratulations, you own a home that only has $40 worth of work. Woohoo! So if they tell you they got to rewire the whole house, well, and that may cost you 10 grand. Well, that's something good to know now, because maybe you can negotiate with the seller, to either change the price, do the work, or just cancel the contract. Additional inspections will be meth, mold, and radon. So I'm going to ask you a question. So what do you think the number one demographic that's positive for meth? Take a wild guess at the number one demographic that's positive for meth. What do you think? Any guess, Andrea? Connie, any guess? You're muted, Connie. So the catchphrase of the 21st century, unmute yourself. So, oh, there we go. I had the button click. Now you can unmute yourself. I had the button checked where you couldn't unmute it. So it should be usually at the bottom of your screen. You see a microphone with a line through it. Oh, white males. No, believe it or not, and they may be the culprit, but that's not the demographic who owns the house. It's granny houses, grandmothers. And here's the reason why. Yeah, it's shocking, right? Here's the reason why. So these, meth addicts, they burn through everybody else. Grandma takes them in. They're living in grandma's basement. They're down there getting high for a year. And now granny's got a house that's got problems. Isn't that wild? But it's the truth. And then mold, mold you look for, typically an inspector, you can smell the dampness. And usually the inspector will say, hey, I'm smelling some stuff, may want to have some moisture mold test. And they can do that. They have, they can do quick moisture, but the mold is where they actually take samples and then, go and have it examined at a lab. Now, every house has mold in it because the mold is in the air outside. It's just a question of, do you have mold behind the walls accumulated inside? And then another test is radon. So radon is a naturally occurring gas. It's a heavy air. It's heavier than air, so it sinks to the bottom. So what they do is they drop a machine in the basement, and they leave it there for 48 hours, and then they do a reading. So if it has like a 4.0 or higher, then they're going to say, hey, you might want to consider some mediation. And so now here's the thing. If you got a basement and nobody's living down there, you might not care too much, because it's only if people are living down there and they got beds low to the ground that it could become a problem. Now, I'm not that's not considered legal mold advice, but that's, my working knowledge of way radon air. And so the way they fix it is, it's a pretty simple fix. It's usually about $1,500. So what they do is they drill a hole in the floor in the basement, and they drop a pipe down in there, and the pipe has like holes in the side. And then what they do is they run the pipe up through the floor, and then they go out of the building, and then they go up above the roof. And then partway up, we lost Andrea. And so partway up, there's a fan in there, and the fan pulls that air up. And so it pulls the radon up above the roof line. So it's not, if you have a lot of radon, it's not a disaster. It's a pretty easy fix. So any thoughts, questions, or concerns on inspections? So another mistake is skipping the final walkthrough. So let's set the stage for you. You're excited. You go sign the papers on Monday. The loan funds and records on Tuesday. In the contract, the seller has a 48-hour possession, or say 72 hours after funding. So you're going to get the keys at 5 o'clock on Friday, and you go over to the house at 5 o'clock on Friday, and guess what? The seller's still living there. Oops. Yeah, right. I mean, now we got a nightmare on our hands. You got to get them out, and for whatever reason, maybe their plans fell through and they're stuck. It's unfortunate, but it's like, well, that can't be our problem, but it is our problem by association, because we have a problem. And so, the other thing is, the place could be trashed. They pull all the paintings down. And so, like, you hear the story of, they walked through the house. They kept, every time they walked in the room, they opened the door, looked in the room, and then closed and left. And then when they went in, they moved in the house, the backside of every door had holes in it. They weren't really looking good. They were skipping the inspection, skipping the walkthrough, stuff like that. So you got to, you want to make sure you don't do any of that, So the two purposes of a walkthrough is to confirm what you purchased is still there and intact. And then, or if you have any negotiated repairs. So let's say you negotiated some repairs and you want to make sure that they were corrected. The seller agreed to fix the double tap breaker in the electrical box. And, they don't have to have it done until closing unless you're negotiated a different time frame. So anyway, you want to make sure that everything you bought is still there. or any repairs are done. Make sense? And then let's see. What if the appliances that were included are not there? You show up, you bought the house and it had and with the contract that came the refrigerator, the microwave, the stove, and the dishwasher. And what if you show up and the house is gone and all the appliances are gone? Now you can sue the seller, but in the meantime, you're trying to move. And I mean, who wants to sue the seller? I just want to move in my house and make dinner, you know? Or what if they haven't moved out? We talked about that one. That one's a nightmare. I mean, it happens. That's why, you show up and you inspect prior to, because you go before you release the money. So you can go in and sign all the papers with the title company. And let's say the next day it's going to fund and record. So you run over there and do the inspection and make sure they're not there. Or in some houses you can tell, like if the house is in immaculate condition, things like that, the odds are great, you're not going to have problems. But, shame on you, or shame on us if we don't coach you in to make sure you do it right. Any thoughts, questions on that? So in the beginning, I asked how everybody felt. Do you feel concerned, stressed out, intimidated, anxious? So now how do you feel, right? So after going through, 45 minutes of coaching, as your attitude changed. So Connie, are you a first-time home buyer? So sorry, I had to get my daughter. Can you? Absolutely. I'll send you a recording of the video too. And also I'll send you the link, Connie. If you want to schedule a time, you just go to the link, pick a date and a time. So when you click on the link, it'll pull up a calendar. The ones in blue have availability. You click on that date and it'll show you what times are available. You just click on it, fill it in, and boom, we have an appointment on my calendar. Have fun. Pick up your daughter. Say hi for us. So hi, Miss Andrea. So Miss Andrea, do you have any questions? You're muted. So any questions, Miss Andrea? You're muted. Usually at the bottom, there's a little microphone with a line through it. Now we got the big guns in to help. Not able to figure it out, huh, Connie? I can't hear you. I mean, Andrea. Okay, try now. There we go. All that
Okay.
time, it actually was me. I apologize.
Um,
Do you have any questions?
okay, so um if I were to buy a home in the area, anywhere in Salt Lake City area,
Okay.
um, is that considered as the F, what do you call it? The, moving from the rural area?
No, nothing in Salt Lake County qualifies.
Like for the loan, if I move from there, am I gonna get credit for that
What do you mean if you move from there? What do you mean? Where's there?
into Salt Lake?
No, nothing in Salt Lake County qualifies for the USDA rural home because
Okay,
rural is where there's hardly any people live.
yeah,
It's, out in the farmland and stuff like that. So now we do have a couple small farms in Salt Lake County, but there's nothing in Salt Lake County that's rural.
okay, I get
But we
it.
can help. So what's important about the USDA loan to you?
Um, well, if I'm moving from a rural area into the city, like right now, I'm just renting.
You live in rural community now?
Yeah,